How to tell when a stock is cheap or expensive. That's definitely one of the more common questions that I had when I first started picking individual companies for my portfolio. And what I realized over time is that stock multiples like PE ratio or EV revenue, they are a great way to tell whether we're getting a great deal for a company or we are paying too much. So in this video, I want to focus on stock multiples and walk you through my process of how to tell whether a company is cheap or expensive. It's also really important to know that I use stock multiples to justify spending more time researching a company, not to make decisions. As usual, if you learn something new, it would mean the world to me if you could gently smash a like button somewhere around here and know this video is not financial advice or recommendation to do anything. So without further ado, let's go. So I've broken this video into two main parts. First half of this video will be dedicated to multiples I use for growth companies, and then the second half will be more of the multiples I use for mature companies. I'll also use actual examples so you understand what to watch out for and my own thinking process when I'm using multiples to gauge whether a company is cheap or expensive. Timestamps are in the description box below, and I want to start with the growth stocks first, and then we'll talk about the mature companies. With growth stocks, they're reinvesting all of their earnings or cash flow into growing the business faster. So PE ratios and also EV/EBITDA just isn't going to work because they're all negative. And I'll show you what I mean by that. Snowflake is a really good example. So when we go to the valuation tab and then you go to multiples, you can see that all of the forward EV/EBITDA, price to earnings ratios, it's all negative. And depending on how open-minded the investor looking at this is, they might conclude that because the price to earnings ratio is negative, therefore this isn't an overvalued stock. Or they can look at the EV revenue and say that, hey, it's trading at 56 to 60 times revenue. This seems really expensive and therefore it's overvalued. I'm going to show you in just a second why just because a company is trading at a high revenue multiple, it doesn't necessarily mean that the company is overvalued. This template and the general format in this template is what I use to determine whether a growth stock is worth my attention and worth spending more time doing research. And the first step is actually trying to understand whether they're trading above or below the 52-week high. But the main, the meats and potatoes of the template is actually in these three steps here. I'm trying to understand the revenue growth rate over the next 2 years for the company, the enterprise revenue multiple, and what would the multiple be when we adjust it by the growth rate so that we can have some kind of understanding of what the value is amongst the companies in a similar industry. Then the final step is to understand whether there's some kind of expected return if we were to hold on to the company for 2 years at the current growth rate. So the best thing to do now is to show you where I get my numbers from and my thought process when it comes to thinking about whether Snowflake is cheap or expensive. So the first step is finding the revenue growth rate, which is pretty simple. We want to go back to ticker and then we want to go to estimates and we want the 2021 to 2023 estimate. And you can see that the compounded annual growth rate is around 75%. And that's what I have over here. The enterprise value is also easy. You just go to overview. And then TEV stands for total enterprise value. And we just want to put in this number right here. Now the number is a little different because I got numbers from the previous day. So it will look different by the time you are watching this video. And then the next 12-month revenue, you go back to estimates. And then we are looking for the 2022 revenue. It's about $1 billion. So that's what I have over here as well. So the EV revenue multiple is just enterprise value divided by this number, and we should get a forward EV revenue multiple. Now to go the extra step, I actually like to adjust this multiple by the growth rate so that we can put things in perspective. Now it's really important to know that you should divide 63 by 75 so that you get a growth adjusted multiple. Don't divide it by the decimal, otherwise you're going to get a wonky number. Now for step 3, to get the average EV revenue, the historical one, what we want to do is we want to go back to valuation and then go back to the forward EV revenue. Now, because this is a company that recently IPO'd in September, there's not a lot of history. And this is a really good time to actually build in our margin of safety just in case we're wrong. The best case scenario is actually be really conservative and still have a great expected return. So instead of giving them an average forward EV revenue of 70 times, I am going to hypothesize that in 2 years' time, the EV revenue will be around 35 times, right? So basically half of what the average is now. And I think that's fairly reasonable. And then the exit enterprise value will be essentially growing the revenue by this rate for 2 years, and then times by 35. You can see the formula right here. And the expected return is comparing the exit enterprise value to this number right here. Right? So if you want me to make this template public, just let me know in the comment section below. And I know that it can be a little bit confusing, but I would love to just be able to contribute to your growth as a retail investor as well. So now that we have all the numbers, we are ready to make some observations on whether Snowflake is cheap or expensive. The most convenient observation that people most likely want to make is that when they look at a company like Snowflake, it's trading at 63 times revenue, they will essentially just jump to the conclusion that like, hey, this company is really expensive, I don't want to touch it. But what's really interesting is that the market don't often misprice assets, especially a big company. So if a company has a high valuation, there has to be something that justifies the price. And most of the time, it really comes down to the revenue growth rate. Right? So when we look at Snowflake, the revenue growth rate is 75% compounded annually. It's essentially double compared to some of the other companies. That's why they're getting a higher multiple compared to everyone else. But if we take it a step further and adjust the revenue multiple by the growth rate, you can actually see that amongst the 6 companies, Cloudflare and Zscaler is actually more expensive at a cheaper multiple because of the growth rate. Now, this growth adjusted multiple right here, we want this number to be as low as it possibly can be. And you can see that Snowflake, because it's growing so fast, it has a 0.83 times growth adjusted multiple. And the average amongst the 6 is 0.93. So it's actually below the average growth adjusted multiple as well. Based on everything we just did, it does seem like there is something in Snowflake that's really worthwhile doing more research on. And this is actually a company that's currently on my watch list. And I know that the more close-minded investors will be throwing the pitchforks at me at this point. But to be perfectly honest, I am just trying to develop my own style of investing and also trying to be more open-minded. With more mature companies, there's a consistent stream of cash flows and earnings. So it's actually my preference to not use stock multiples, but to use discounted cash flows for that. And I've done a full video on how to use my discounted cash flow model template in how to research stocks before investing. So feel free to check out that video after this one, and the template is in that video as well. But to complement my DCF model, I often look at stock multiples as well. So I want to show you an example by looking at Amazon. For more mature companies like Amazon, my go-to stock multiple is next 12-month EV/EBITDA. The reason why I love enterprise value multiples is because it takes into account debt and cash, whereas price to earnings ratio don't take into account debt and cash. Now, to tell whether Amazon is cheap or expensive at any given point, you want to go to valuation, click on the next 12-month EV/EBITDA so that it charts the graph, and then you stretch it to either 10 years or all, really up to you. And you can see that the average next 12-month EV/EBITDA is around 23 times. Okay, the other thing that was pretty obvious by looking at this chart is that it's not very often that Amazon trades below the historical average, which is somewhere around that 20x mark right here, right? Not very often, and it doesn't happen for long either. But for a brief moment, Amazon traded below its historical average of 23 times in March 2021. And that's when I started thinking about whether there is an opportunity with Amazon. This alone doesn't tell you whether if it's cheap or expensive. You really have to do your fundamental research to try to understand whether the company is going to continue to grow and the market is just wrong for a brief second. So based on my own research, Amazon seems like a pretty good deal. So I built my first position over here, and then I added to my position, I think somewhere around this point as well. If you prefer to use price to earnings ratio, I've actually adapted this template that I use for growth stocks. Instead of using EV revenue, we'll just use the PE ratio. And adjusting the PE ratio by the EPS growth, that's how you get a PEG ratio. And this is like the exact same concept of making some observations based on the table right here to see whether these companies are cheap or expensive. Now, let me just quickly go through how I get these numbers and my thought process when it comes to looking at whether Bristol Myers or Regeneron is cheap or expensive. To get the 2-year EPS growth, we just go to estimates, go to EPS normalize, but sometimes you don't get the 2023 estimates, you only get up to 2022. So we're going to use this number right here, but we're going to tame it down a little bit because growth tends to slow down over time, right? So 7%, very reasonable. Share price is just the current share price of recording this video. The next 12-month EPS is just the 2022 numbers of earnings per share, and it's around $8 estimated. And the forward PE is just 67 divided by 8, and it's around 8 times. And the PEG ratio is just 8 divided by 7, and you'll get a 1.18 times. To get the average forward PE, what we'll do is we will just go back to valuation, and then we want to click on next 12-month price to normalize earnings, and then stretch that time frame to 10 years, and you'll get an idea of what the historical average is. Now, again, this is where we built in our margin of safety. So instead of putting 20x, I have put in 15x just to be a little bit more conservative. And the exit share price is taking the next 12-month earnings per share, growing it by 2 years, and then giving it a 15 times forward PE. What would the share price be after 2 years? And it's around $138. And you can see that there are some expected return for certain companies and others not so much. And when we look at a valuation perspective, you can actually see that the forward PE, Bristol Myers have one of the lowest forward PE, but when we adjust that to growth, it's actually pretty expensive among some of the other companies. Not as expensive as Johnson & Johnson, but definitely more expensive than Merck and AstraZeneca. So to be honest, multiples is just a good tool to prioritize your time. But besides that, I don't think that it's a good tool to make decisions from. And at the same time, please remember that multiples are all relative. Just because a company have a high multiple doesn't mean that the company is expensive. Thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.